This video is going to be way different than what you're expecting, but hang in with me for a few minutes because our first topic is going to be a big surprise. And then afterwards, I'm going to share what I believe could be the biggest trap in the entire investing world right now. And I'm going to share with you a value stock that appears cheap right now based on a quick glance at the price it's selling for and the metrics involved. But of course, we're going to analyze it the everything money way to see if it's selling below its intrinsic value or not. Because as we always say in every video, price and value are different things completely. Guys, my team queued up a video for me to watch and I've never watched it. And the reason I'm smirking is because Tim has been so excited about this video that yesterday he almost slipped to me some things. He's like, no, I'm just gonna wait till you see it and everything like that. Let's watch this video. We're gonna watch the whole segment and then I'm going to discuss what's going on with it.
The Nasdaq made 20%, Paul of Everything Money made a bit better with a 22% return. He picked solid stocks like Meta, Google, Visa, unfortunately also Adobe that dropped 21%, but he was the only one that went with Johnson & Johnson plus 43%. What? Great pick. Congratulations.
No. Hang on a second. So first off, very nice guy. Like you can already tell he's and there's no criticism of him. That was all wrong. Yesterday I was on a call with Dalton and he told me what my returns were. And I'm like, Dalton, why'd you tell me that? He goes, I'm sorry. I'm like, Dalton, I care about the last 3 years, the last 5 years, not last year. Guys, this is what he told me I did last year. You ready? 15%. I didn't beat the market and I definitely didn't do 22%. And I don't own Meta anymore. I don't own Google. I don't own Johnson & Johnson. I do own Adobe. All right, guys, let me be crystal clear here. I'm not here worrying about beating the market on any individual year with only stocks. I'm not trying to flex some top stock picks of the year list. I'm not here to show off a portfolio and say, hey, follow what I'm buying, you'll be rich. And by the way, it makes me remind me, he doesn't know my position sizes on anything. You could pick all my stocks, but if I have 10 stocks and 90% of my money is in one, you can't possibly determine what my return is. I always tell people, I will tell you exactly what I own, but I will never tell you the position size because there's a lot of legal ramifications to that. But I will tell you exactly the companies that I own. I talk about it regularly, but if you want to build wealth, you've got to stop thinking in 12-month windows. Now, though, look, the reality is this. Yes, I've beaten the market a lot over my investing career up until about COVID, but not because I'm buying hype stocks or guessing which stock is going to double this year. If you include my real estate, if you include my businesses, if you include all my major mistakes, I have not only beaten the market, I've crushed the market. But remember, that's with my real estate and businesses involved. It's unfair to sit there and say that this is the right way of being because most people out there can't have the businesses and the real estate. And guess what? With stocks, up until COVID, I beat the market over a long period of time. On any given year, though, it was random. It's always going to be random. But the point is, if you have a good process that is driven in value, then when markets are bad, you probably won't do as bad. But you're going to be accumulating shares at cheap prices. And then when the market turns around, you're going to make a lot of money. Guys, I own 1,000 units, apartment units upstairs. My biggest issue is I think we're too conservative because all of our deals do very well. Our annualized returns on those deals are well over 15%. In fact, about 20% of them are making 30-40% plus returns in real estate. On the stock side, I don't care what my returns are in any given year. Remember one thing, I have X net worth here, whatever that net worth is. I did the math the other day. 25% is in my brokerage. But of that 25%, so let's do the math here. About 20%, which means about 5% of my entire net worth is in stocks. Of the 75% that's not invested, it's in real estate and businesses. Guys, I could make 3% a year for the rest of my life on this 25% in cash, and I will still grow at 9 or 10% a year because of these two things. But you got to remember, you cannot possibly look at my returns on any given year and say, oh, Paul underperformed, Paul outperformed. Who cares? What matters is, do I have good companies at good prices? So last year, the market said to me, hey, Paul, here's 15% return. Yeah, but guess what? The market was up a ton. So I don't care about this. And guess what? If the market was down 20%, my guess is my stocks would probably be down between 10 and 20%. It could be more. I have no idea. But this is what I try to teach on this channel. Everybody's so focused. How many people out there are sitting there talking so openly about underperforming. I could not care less. Just like when I have a stock that skyrockets, yeah, it's nice to know that, okay, my thesis might be coming true, but even then, I don't say I'm right. I've made money on Carnival Cruise Line and Walgreens. Two stocks that I sold very quickly after I realized I was wrong on them, and I made money. Did that make me right? No, I was still wrong. I just happened to have the market momentum shift in a certain way that made me money on it. This is what I'm talking about. Look at Adobe. Adobe is now down today below $300 per share. Guess what I'm doing? Time to sell some cash secured puts on that bitch. And because I'm able to buy undervalued businesses when everybody else is criticizing them, that ability there has nothing to do with up here. It has to do with here. Because at the end of the day, when I'm buying companies that are falling, the noise out there is these companies are bad. That's what caused them to fall. But in order for me to be able to pull the trigger on them, it takes a stomach that I have. This is why I say dollar cost average in a low cost ETFs, and you have the stomach to buy individual stocks when they're beaten down, you're going to make a killing. But how I can and will beat the market with stocks is because I use many different strategies, one of which is cash secured puts to generate income and buy shares at lower prices of companies I want. I sell covered calls to create cash flow on stocks I already own. And guys, none of that shows up in this video. And I give him credit for analyzing it because I think it's fun to do that. But our investing at Everything Money isn't about what's hot right now. My goal is to help you beat the market over decades, not over the next few weeks or months. That means teaching you how to think about investing, not just giving you fish. I want to show you how to fish. I want to show you how to build long-term wealth so that you can sleep well at night, knowing that your future is taken care of. And guys, even when we post videos about my 7 stocks versus the Mag 7, I'm not telling you to buy those stocks. I'm showing you my process, and I'm putting my money where my mouth is. I'm sitting there saying, hey, these are 7 companies that I think are better than these Mag 7 from a valuation perspective. Let me go sit there and show you what they are and see how they did. And guess what? In 2025, they didn't beat the Mag 7. I'm okay with that. There's no like, oh shit, what do I do? I've got to save face. I'm like, okay, they didn't beat last year. We'll see what the next year looks like, and the next year, and the next year. And there'll be a time when it's crushed and people will say, yeah, Paul, but what we didn't realize was blah, blah, blah was a fraud or blah, blah, blah happened. It's like, that's the point. The point is everybody buys the hype at the wrong time. I am teaching you how I look at companies. I am making a point that just because something is big and great and awesome, like the current Mag 7, doesn't mean they're going to be the leaders in 10 years from now. In fact, the biggest stocks today are often the ones that are hit the hardest when the market corrects. Why? Because they make up such a big part of the portfolio, big part of the index. When they fall hard. So if you're watching this channel hoping for a hot tip or next week's winner, you are in the wrong place. But if you want to learn how to think for yourself, how to value businesses, how to ignore hype, and focus on long-term returns, you're exactly where you should be. Now, back to this video. He mentioned some stock picks like Johnson & Johnson. That literally melted my brain. I'm like, I don't remember even saying I was buying Johnson & Johnson. It is on my list of 33 stocks that I want to own. And I probably analyzed it sometime in 2025, along with over 600 other stocks last year. Between this channel and the Everything Money Plus channel, we analyze 50 or more stocks every single month. Inside our community of Everything Money community, those community members have analyzed over 6,000 individual stocks last year. Over 1 million times they use that stock analyzer tool. So each video and every month we journey together on this channel and inside the community, what we show is the process. I show you what I think is overvalued and what looks potentially interesting and how I'm going to track it. We talk about 52-week lows, valuations, earnings growth, all in context, not just throwing out names. And here's another really important point. Even if everything someone says about my portfolio is 100% true today, it might not be true tomorrow. I might buy or sell any stock at any time based on new information or just based on other opportunities. You don't know my cost basis. You have an idea of my strategy, but my strategy is different than your strategy. Why? Because we're different financially. We're different in terms of where we are in life. I'm 44 and I'm essentially financially free. You might be 25 just getting started out. You might be 65 and close to retirement. Our goals in all 3 of those situations are totally different. This is the danger in following YouTube personalities that just want to show you what stocks to pick. Guys, and by the way, this guy is the worst of all of them. I'm just going to tell you right now, and I hope somebody who knows them tells them. I once reached out acting like a potential client, and it was absolutely terrible. This guy should be added to our list of financial manslaughter. This guy is the worst. Most of these other YouTubers don't even know what they're doing. They just happen to pick a stock and make a video and it went up a lot. Great. How many of them are now big because of Tesla? Tons of them. It's not malicious. I don't think they're really trying to be shady, but they're still causing damage. Why? Because a bull market makes morons feel like geniuses. Guys, I truly, truly, truly believe this channel is different. We care about process, not predictions. We're not trying to look brilliant here. We're just trying to act intelligently and calmly. That's why you're here, and that's why you're going to win. All right, next topic. This is what I believe could be the biggest trap in the entire investing world right now. Now, stay with me for a minute to hear why before you take offense. Guys, and this is a new one. I've never said this before. Bitcoin and crypto. Just kidding. I say it all the time. Guys, here's an article from Yahoo Finance. Gen Z investors are 4 times more likely to own crypto than retirement accounts. Here's how financial experts say they should actually invest. Well, first off, when you buy crypto, you're not investing. You're speculating. More power to you. But to say that it's an investment is not understanding what investing is. I really believe that the future generation is creating a massive financial trap for their future, and they have no idea, they don't even realize it. Right now is when the people in their 20s should be maxing the heck out of their 401ks and IRAs and putting that into low-cost ETFs that will grow over time. But instead, they're buying crypto. Guys, there was an article recently where it said the biggest FanDuel and DraftKings people are crypto people. Why? It's all gambling. This should not be confusing you why the best value investors ever are not gamblers. Why? Because they don't believe in gambling. They believe in having an edge, understanding something people don't. And every crypto bro in the world says, well, I understand crypto and everybody else doesn't. If you don't know who the sucker at the table is, you're the sucker. Bitcoin is nothing. It's nothing right now. Could that change? Sure. The funny part is, I think if it became adopted as a regular currency, I think the price would plummet. The value would plummet. People buy it for big gains. Does a dollar gain? Everybody in Bitcoin and crypto world goes, the dollar, fiat currency loses value all the time. It's like, well, that's what you want Bitcoin to become, is this currency. And just because it's limited in supply, you can sit there and say, well, that means it's going to be worth a ton forever. Maybe, but what's the backing of it? This is merely the digital financial version of the tulips, of Beanie Babies. Look at all the scams that are coming out about Bitcoin. There will be scams on real estate. There have been scams and will be scams on stocks. And those happen at the most obvious times of financial euphoria. I'm not telling you not to trade Bitcoin. It's an asset that goes up and down. Trade the hell out of it. But if you think you're buying an investment, you got to keep in mind, I don't think gold's an investment. I don't think land sitting by itself is an investment doing nothing. I believe an investment is something that generates income, that if the market for that asset should shut down tomorrow, I still have use for it, and I'm okay with that. If the cryptocurrency market shut down tomorrow, what's your crypto worth? How's it going to make you a return? If the market, and the same can be said for gold, art, and a bunch of other things. I get that. And that's why I say those are not investments. Now, at least gold has other uses. Now, I got that off my chest. Let's look at a stock that our community has been having some solid discussions about recently, HPQ. And that's why we're going to take a closer look at it. Now, on the surface, HPQ looks very cheap. Sells for 7 times free cash flow. Our community members have it as a buy. It is selling dirt cheap. PE 7.7, price of free cash flow 7, returns on capital. Look at that, 43% last year, 80% for the last 5 years. But guys, here's what sucks about it. Look at this revenue growth last 3 years, down 4% a year. Last 5 years, basically even. Last 10 years, up 0.7% a year. This is not a grower. Now guys, I used to own HPQ. I don't know if I still do or not. I just reached out to Dalton to find out if I do. I might have lost it to covered calls. But remember, I don't just want to buy a stock because it's cheap. And this one was a company that I was kind of like, hey, listen, I know it's a declining business, but I thought it was cheap enough. And I still believe that to this day, that if you buy a bad company or a declining business at the right price, it can still make a lot of money. The example I'm always giving, blue chip stamp company that Munger and Buffett bought in the early 70s. It did $120 million a year in revenue when they bought it. 12, 13 years later, it did 100,000 in revenue. 100,000 in revenue from 120 million, a drop of 99.99%. But they still made 15% return on their money because they paid the right price. So the last couple of years, the stock has taken a big hit. Why? Demand for PCs and printers, which are HP's core business. It's been weak. Think about it. More people are working digitally and less are printing stuff. That hurts HP's printing business. On top of that, the company's been dealing with rising costs, especially for parts like memory chips. That squeezes their profit margin, which is just a fancy way of saying they're making less money on every product they sell. Right now, their gross margin is 20%. Last 10 years' profit was 6%. Last year was 4.5%. But it's still a really cheap business. And the key is, if they can buy back enough of their shares, that is a huge gift for them. Now, guys, they've given lower profit forecasts for the next couple of years, which of course disappointed investors. And with all the economic uncertainty, trade issues, and talk about AI, some people are even calling HP an AI loser because it's not leading the charge in AI infrastructure like the other big tech names. But here's the other side of the story. HP has a plan to fight back and grow. First, they're working on something called an AI-enabled transformation. That means they're putting AI into their computers and operations to improve how everything works. And they've already launched a new line of AI PCs to try and get ahead of the competition in the personal computer space. They're also trying to save money, about $1 billion by 2028. That includes cutting costs, reducing workforce by a few thousand employees, and moving some of their manufacturing out of China to avoid tariffs and other global issues. Next, HP is focusing more on recurring revenue, things like subscription services for printer ink and paper. This makes their income much more stable and predictable, which is a good thing in a tough market. They're also expanding to 3D printing and industrial graphics, areas where they've seen some double-digit growth. And they're not just relying on what they've always done. They've made smart acquisitions like Vyapta, which helps with workplace collaboration tools, and they've partnered with big names like NVIDIA and AMD to stay competitive in key tech areas. Finally, even though they've had challenges, HP has kept returning money to shareholders. They've raised their dividend every year for the last 10 years, and they're still buying back a ton of shares. That tells us that management believes in the company's long-term future and its ability to keep generating cash. So is HP a buy right now? Well, it's definitely cheap, but we still have to ask, is it a great business? Is it an okay business? Is it growing in the right places? Can it handle the changes happening in the tech world? These are all questions that we need to look at and think about before we jump in. So let's take all of this, run it through our stock analyzer tool to see what price we'd be willing to pay for HP. Now, guys, high return on capital, low price price of free cash flow. Remember, British Tobacco was a company selling for 5-6 times free cash flow. It was in a declining business of cigarettes and tobacco, and now it's doubled and pays a big dividend. The dividend here is 5.6%. HP, can I give you advice? Cancel his dividend. You've got lots of debt, $58 billion versus a $20 billion market cap. That difference right there is debt. Use it to pay down debt and use it to buy back your cheap shares. Let's go see how much their cheap shares have been buying back. Guys, 10 years ago, they had 1.73 billion shares outstanding. Now they're at 940 million. That means even though their net income went from 2.5 billion to 2.5 billion, it's the same. Now every share essentially gets double the earnings, double the revenue, double the profit that they got before. That's how they give money back to their investors. So instead of paying that dividend, which I know people love, buy back more shares. Now, guys, I went through these key metrics real quick. It's overwhelming, and I get that. But remember, it was overwhelming for everybody in history at some point. I'm here to make this easy for you. Cheat sheet that I made, download it here, click the link. We will email it to you immediately. It explains all of these key metrics for you so you can sound smarter and actually be smarter as well. 8 pillars. All right. Cash flow growth, net income growth, revenue growth, all X's. Declining business. They have to turn things around. Let's see if they can. But everything else is a check mark. Guys, forget about $1 per share. If I told you could have HP tomorrow for $1, would you buy it? Of course you would. You make your money back in a millisecond. If I told you to pay $1 trillion for it, would you buy it? Of course not. Somewhere in the middle, it's a really great investment no matter what's going on back here. That's the kind of mentality I want you to have. It might not be right, but that's the mentality I want you to have because too many people attach themselves to the story instead of the numbers. Let's see what analyst estimates are. Ironically, guys, $3.40 per share. Not much growth, but still growing from here. Revenue, they actually have a little bit of growth in the revenue. 1.6, 1.7, 0.8, and 1% revenue growth. But guys, at the end of the day, what we care about is what does the stock analyzer tool tell us about the growth of the business and the price you have to pay today? I'm going to pull up my assumptions here. Guys, this is what I want you to see. -3, 0, and 3% revenue growth for the next 10 years. Think about that. I assume -3% on the low side per year. And by the way, in the last 10 years, they actually had some positive growth. And I'm assuming 0 growth in the middle assumption and 3% growth, they kill it. That is not good, guys. That is not high. This is very important you understand this. That's what the stock analyzer tool is here to do. Take our assumptions and then sit there and put it in and say, what's the right price to pay? Next, profit margin. I did 5, 6.25, 7.5. Guys, let's go lower. Let's go 4, 5, and 6, even though they plan on cutting a lot of costs. Now, declining business, high returns on capital. Guys, I did 10, 13, and 16 times earnings. That's a PE of 10, 13, and 16. That is super low. And finally, a 9% return just to say, hey, listen, based on these assumptions, what would the market intrinsic value be for this company? The stock's currently at 20. Guys, I know exactly how it feels to be paralyzed by fear in the stock market. You're probably thinking, I know I should invest, but what if I buy the wrong stock? What if I lose everything? I had those exact same fears 25 years ago. I made massive mistakes. I followed hype, I followed tips, and I lost money. But critically, every mistake taught me a valuable lesson about investing. And that's exactly why I decided to build Everything Money, to take that knowledge and turn it into the tools I needed to make better investing decisions. Now, I want to share that knowledge and those tools with you and build the community that I wish I had back then. So join our community and you'll learn how to see a company's value, how to make smart choices, and most importantly, how to sleep at night knowing that you aren't gambling anymore. You're now an investor. So start your 7-day trial today. Let's take the fear out of investing together. I hit the analyze button. This is why it's interesting to me. I have a low price of 20, high price of 56, middle price of 34, middle return of 17% per year. That includes that dividend, so don't add the dividend on top of it. The question you have to ask yourself, is this worth it? This is the key here, guys. At some price, it makes sense. I will tell you my biggest issue is that balance sheet. Now, if you want to see the 30 stocks that I want to buy in 2026, these are great businesses that I plan to buy when they sell for a great price and hold forever. Click the video right here on your screen. Thank you for your time.